This is the Asia Trade. I'm Annabelle Droulers in Sydney.
I'm Avril Hong in Singapore. Your top stories this hour. Asian stocks set to follow US shares higher this Christmas Eve morning. Tech-led gains push Wall Street to a record as data show the economy expanded at the fastest pace in 2 years. The U.S. Justice Department has released more files related to Jeffrey Epstein, including some that could add fresh pressure on President Trump. Also ahead, we speak with the founder and CEO of Brinc Drones about why they're hailing the U.S. decision to ban new foreign drones.
Well, you said it there, Avril. We are in the final trading day before Christmas Day, so you can really expect a lot of traders to already be away from their desks. So holiday-thin trading should certainly set the stage for us. But still, we did see a strong session in the US overnight. So far, not actually translating that well into the Asian benchmarks, because you're seeing Nikkei futures there looking like we're going to see some losses at the open. Aussie stocks as well, just slight declines. But as I said, strong session in the US overnight. It was a tech outperformance once again. So we were watching the tech sector in particular. Also taking a look at what's happening with the miners as well in Australia, given those gains, Avril, that you're seeing across copper, gold and silver.
Yeah, all-time highs on precious metals and on copper as well. You got those supply constraints and the energy transition that's really fueled the red metal this year. But then geopolitical backdrop, Venezuela tensions, of course, that's driven gold to these fresh all-time highs. And of course, when it comes to all-time highs, take a look at the S&P 500, right? You said it's led by this tech bounce, but also holiday-thin trading. Vol has slipped as well. In terms of the data, we got the U.S. economy rising, gaining ground, growing, fastest pace in 2 years, even though consumer confidence is looking a bit wobbly. We did get strong GDP numbers, coupled with a drop in volatility. So far, that seems to be enough for investors to drive these stocks to new records. And if you take a look at this chart, it'll show you implied correlation also collapsing. So that's helped to fuel the rally. Let's talk markets and the outlook for 2026 as well with Bloomberg M Life strategist Mark Cranfield. So, Mark, we have this set up in terms of the data with the Goldilocks scenario. Where are the bears?
They've all gone home for Christmas. They'll come back next year. So it's a strange situation. And if you look at, for example, precious metals going through the roof, VIX index is on the floor. And that divergence is in itself is a warning signal that maybe people are becoming a little bit complacent about what kind of risks lie ahead. At this time of year, you rarely see any pushback. Trends usually just stay in place until the end of the year. As you were saying, a lot of people have gone on vacation already. Liquidity is a bit thinner than usual. So US dollar is on a bit of a downtrend. Typically is at this time of year. Probably will continue into year end. Equities will probably continue to grind higher. People won't be too concerned. By the time we get into next year, if you look at some of the things going on, this disconnect just can't continue. You've got the US economy growing at more than 4%, and yet we're being told that the inflation is really subdued and is staying low. And yet the data collection, there's a lot of question marks whether is this data really believable or not. I suspect once we get into next year, people will start to take these things more seriously, and you will see it play out. The Treasury curve, US Treasury curve, is a place where a lot of people can play that game without maybe, they still believe in the equity rally, but they can take defensive action. We'll probably see some swings in the Treasury curve, particularly at the long end. It's going to be hard to justify having US Treasury yields where they are when there are clearly some upside risks to inflation as we get into 2026. So we'll probably see some big swings there and a pickup in implied volatility as well. The VIX, it's very hard for it to stay on the floor where it is now when people assume it's going to be plain sailing all the way. Those question marks will start to come in, but probably only once we come back in January.
So, Mark, one of the themes of this year was that US stocks underperform their global peers. But against that backdrop of the US economy looking strong going into 2026 with those fading fears around tariffs, more expansionary fiscal policies as well, do you see that flipping once again? Because, I mean, you can see here in this chart, it's pretty unusual, actually, to see the US underperforming the world index.
A big part of that is the currency angle. So a lot will depend on where people see currencies in relation to the US dollar going in through next year. And there's some pretty strong trends already in place. and they're quite possibly going to extend as well. So if you look, for example, at the Chinese yuan, it's getting pretty close to that 7 line. If you look at the way that the forward pricing goes, traders are expecting the yuan to get even stronger next year, to go below 7 against the US dollar. That's very good for the Asian currency complex. Euro's banging on 118 at the moment. People are predicting 120, 125 into next year. So if the US dollar continues to grind lower, that is going to support moves away from US markets into Europe, into Asia, other parts of the world also. Latin America, Brazilian real is a standout there as well. So there's plenty of reasons for international investors to move their money away from the United States as we get into next year.
For the moment, though, we are seeing in terms of Asia futures, maybe on the ASX 200 as well, is looking a bit soft. What is today and the rest of the year going to look like?
The Australian one is probably a knee-jerk reaction to the Australian dollar. It's having a great week. It's touching on 67 against the US dollar. In the very short term, that's probably a little bit of a knockback to the Australian markets. They're used to having a very soft Australian dollar to help the exports. Maybe also some concerns about what's going on in the metal space as well. It's a bit overdone there. So people reining in, taking a little bit of profit before the end of the year. Volumes will be very low, though. So it's very hard to read too much into anything that happens between now and 31st of December. You can't really read a great deal into it. But it's certainly during this time where people will give them a chance to assess whether these trends are sustainable into January or not.
Mark, always great to chat. Thank you for the context, Bloomberg M Live strategist Mark Cranfield. Now let's dig a bit deeper into the outlook for the U.S. economy after it had its best growth in 2 years in the last quarter. And this was thanks to solid spending by consumers and businesses amid calmer trade relations. At the same time, recent data shows consumer confidence dropping, resulting in a K-shaped dispersion in spending. Let's get more on the outlook for the U.S. economy. Jeanette Garretty, chief economist at Robertson Stephens, joins us. Jeanette, last one for the year, but talk to us about what you're seeing in terms of the data. GDP looks strong, consumer confidence looking a bit wobbly. How should we be thinking about this?
Good question. Nothing like going out with a bang, right, with these numbers here. Anyway, you look at the data, the 4.3% growth seems to be not only a good number, obviously, but a solid number in terms of its sources. I will mention there is one factor that's kind of boosting that number a little bit higher, which is the swing on the trade side, the swing downwards on imports after they were built up the beginning part of the year and then drawn down in the second half of the year. That drawdown in imports while exports go up has the effect of boosting economic growth. Up until this point, we were getting a fairly strong read that the U.S. economy was growing at somewhere between 3 and 3.5%, and that's maybe, if you take away the import-export data, the message you get. Certainly that's the message you get from consumer spending, 3.5% growth. Now, the message you get is people may say they feel a certain way, but they also then may go do something else depending on what their pocketbook allows them to do. And the spending is there. It's been very clear throughout the holiday season here that the dollars have been exceeding retailers' wildest expectations, and that it will continue. So it's a challenge. I think what's in the consumer confidence number is people are unhappy because of this affordability concept, but you can say something is too expensive and then still go out and buy it. That seems to be what we're doing.
What's the concern, though, that you're seeing that dispersion, though, between, yes, some people have got a lot of disposable income, and you've got it again in this chart, that K-shaped spending. The wealthiest spenders are holding up, but a lot of people are really struggling with cost of living.
This is absolutely the case. And this is not just a development that has shown up right here and now. This has been sort of the story for a number of months. There may be some help with that along the way, maybe, because the way tax refunds are going to play out next year, that will benefit some of those people from an income standpoint. But the lower end of the consumer market is the market that is significantly exposed to high prices in groceries, high prices in consumer staples, and spend a lot of their budget on those things. And it's just prices aren't going to come down. So even if the inflation rate is moderating, the growth is there. It's going to be a challenge from an economic standpoint. The biggest challenge right now is what is the Fed going to do with this read?
On that note, when it comes to the Fed and us kind of still dealing with this backlog of data, how would you assess the risk of us seeing an FOMC in January and further on out, just picking and choosing the data?
I would pay good money to have video of that meeting. I think it's going to be very intense. And intense in economic circles is always polite. Keep that in mind. But it's going to be very intense. And I think the problem that emerges is, as you alluded to, the biggest problem number of the last few weeks in terms of is this data any good is the CPI number for November. And it's clear it was only 2 weeks of data. They didn't collect a lot of data. They made an assumption of 0% inflation in October. It's not a useful number. So nobody's looking at that. So all you've got to look at is this growth rate and the employment numbers, which truthfully are probably going to be revised downwards. And it's quite a conundrum. Right? Because the Fed has got to say, if employment growth is slowing, possibly flat, maybe even declining, while at the same time this economy is growing 4.3%, my goodness, what are we going to do and what are we doing something about that is going to be impacted by monetary policy? So I think this is going to be a roaring fight, as the hawks say. Well, and we don't really have a good CPI number to go lean on. So we have to assume that inflation is still a problem.
President Trump, in a post on True Social, said that the tariffs were responsible for the great US economic numbers. Is there any truth or substance to that? It seems like maybe the numbers were great in spite of tariffs. So what's your reading on it?
He's listening to economists who are telling him correctly, elaborating on the point that I made earlier on, that the tariffs in reducing the amount of imports have boosted economic growth. Now, this all leaves out the fact that of what the tariffs have done to this consumer concern about affordability. Have those tariffs made some things more expensive? And I think there's been an acknowledgement of that in the rollback on tariffs on things like coffee and chocolate and other things that are maybe not meaningful in the entire budget, but highly visible, that the prices went up substantially because of tariffs. So one of the ones that's being much discussed here in the United States is the skyrocketing price of meat. And that is, in fact, because imported sources have been reduced. So tariffs can be credited for some things positive and probably more than a few things negative. As always, it's a complicated situation.
It's complicated when you talk about inflation, right? We also have, aside from these comments from the U.S. president, his Treasury Secretary, Scott Bessent, on a podcast talking about how maybe it's time to be looking at the inflation target, not just the 2%, maybe look at it as a range. Does that make sense in your mind, given how we're seeing these structural shifts in the economy?
Yes, it does in some ways. And this issue about changing the target from, let's say, 2 to pick a number at this point, 2.5 or 3, has been brought up on a regular basis, even in academic economic circles, for a good long time now, going back several years, actually, but especially this year. And the issue would be if, in fact, there are structural changes at work as we change our trade relationships, as we seek to bring production back into the United States, which is an expensive move. So since that's going to be expensive, should we just accept the fact that there's going to be a higher trend rate of inflation while those structural changes occur? So I understand where Scott Bessent is going. The Fed has been very clear that they're not going to go there. And that has been brought up a number of times. They're always evaluating that target. They have taken that completely off. We'll see.
We shall see indeed. Jeanette, always great to get insights from you. Last one for this year, and we'll see you in 2026. Happy holidays. Jeanette Garretty is Chief Economist at Robertson Stephens. We have more ahead on the Asia trade. This is Bloomberg.
The U.S. Justice Department has released another tranche of files related to Jeffrey Epstein, including some that add fresh pressure on President Trump. For more, let's bring in Bloomberg senior editor John Harney, who joins us. So, John, I mean, it seems like the entire release process has sort of been marred by various missteps, but just talk us through what we got out of this and also some of the details that have maybe been obfuscated a little.
The latest release of files comes after a great deal of criticism of the Justice Department for what were seen as unnecessary redactions, if not omissions. And it seems as if this is not the complete dossier of the Epstein investigations. But we've learned some more about his associations, and for instance, that Donald Trump flew on the Epstein plane more than was thought. But aside from that, I think it hasn't lessened any of the not suspicion, but wariness on the part of those who were demanding these files.
How does that translate into the expectation that this is continuing to pose a political challenge to the president?
Well, the more we're talking about Jeffrey Epstein, the more that presents a problem for Donald Trump. And of course, not just Donald Trump. As we saw in the last release, there were photographs and information about Bill Clinton, which did not make him look very good, although he claims he has continued to claim that he did not know of Mr. Epstein's wrongdoing and cut off ties with him years before those activities did become known. So the Trump administration does not need this as a continuing distraction as it prepares for the midterm elections next November, and how it plans to carry out its economic agenda, with polls showing that many Americans do not approve of the president's stewardship of the economy.
John, this is a conversation that will likely continue into 2026. Thank you for bringing us the latest on this. Bloomberg senior editor John Harney. Now on to some other top global headlines we're following. Nearly half a dozen tankers laden with crude have departed from Venezuela's coast despite increased pressure from the U.S. Data from maritime intelligence firm CATL show most of the tankers are headed to Washington, and at least half of them are chartered by Chevron. This comes as the Trump administration intensifies efforts to curb Caracas oil revenue by targeting sanctioned vessels. The U.S. Supreme Court has refused to let President Trump deploy National Guard troops in Chicago. A majority of judges ruled that the administration failed to identify a source of authority that would allow the military to execute the laws. The move is a setback to Trump's drive to use the military in cities across the country, including New Orleans, where authorities have just deployed 350 troops. The U.S. is holding off on new Chinese chip tariffs until at least mid-2027, despite accusing Beijing of engaging in unfair trade practices in the chip sector. This comes as the U.S. Trade Representative's office on Tuesday released the findings of a nearly year-long inquiry into China's chip sector. The announcement focuses on so-called foundational semiconductors made in China, which are used in sectors such as autos and airplanes. We have more ahead on the Asia trade. This is Bloomberg.
US-listed shares of Novo Nordisk surged on Tuesday after it won approval to sell a pill version of its blockbuster obesity shot Wegovy in the US. Its CEO spoke to Bloomberg about how the development could shake up the competitive weight loss market.
This is really going to be super exciting for the millions of patients that have been waiting to get their hands on a GLP-1 pill. And for the first time, we are having a pill that has an efficacy of some 17% if you take the pill regularly, and 1 in 3 people are going to actually reduce up to 20% weight loss. I think that data speaks for itself, and we are super excited, of course, to be the first to the market, and we're going to go all in trying to make this a huge success.
Well, moving forward, I mean, beyond just these first few months, after Eli Lilly does have their pill on the market, how do you plan to compete? What is your strategy there, given my understanding is that there's likely going to be no restrictions when it comes to food, when it comes to drinks around Lilly's version?
Yeah, so as I mentioned, there are no other phase 3 trials of oral GLP-1 that has shown this level of efficacy. This means that for the first time ever, people do not have compromise between either taking an efficacious injection or a convenient pill. For the first time ever, you have the same efficacy of 17% in injection or a pill. You can take it on a daily basis as a pill or a weekly injection. And that, I think, is the key selling points with Wegovy pill. We also have more than 10 years of course, experience with regards to safety data and what have you. That's why it's called the Wegovy pill, which means that this pill is not only going to reduce your weight, it also has protection for your cardiovascular systems. So this is a phenomenal pill, second to none, I would say, and we are very ready to compete with it.
Let's talk about how you're going to sell it. Through what channels will you sell this Wegovy pill, and will all of those channels be available at launch?
The quick answer is yes. We're going all in. We're, of course, going to sell this through our own websites, NovoCare Pharmacy, as well as all of our partners, be it Ro, LifeMD, Costco, Weight Watchers. Everyone that you can imagine is going to start launching this at the same time on the day of the launch. Trump RX, of course, will be coming up soon as well as, of course, the traditional channels that usually medicine is procured in U.S.
Novo Nordisk CEO Mike Doster speaking with Bloomberg's Katie Greifel. We have more ahead on the Asia trade. This is Bloomberg.
Taking a look at some moves here across the board in the commodities sector, because you're seeing, gains across the board essentially, but gold, platinum, you can see there, copper, we're seeing copper above $12,000 a ton rather for the first time ever. Concerns around supply, of course, tariffs very much feeding into this. That is having a good bearing on the Aussie miners as well in Sydney today, because we have seen the ASX under a bit of pressure, but actually the mining sector is standing out for us. But let's stay with Australia, because some of Australia's biggest funds say private credit investments are growing increasingly risky. And that's due to their heavy weighting toward the property sector. Let's get the details from Bloomberg's cross-asset reporter, Richard Henderson. So, Richard, of course, the size of the private credit industry in Australia is much smaller than what you see in other markets like the US or Europe, but it has grown quite significantly even in this year. So why is there now these red flags, I guess, that are being raised?
Yeah, so basically it's this heavy weighting to property development and developers in particular. So the corporate regulator in Australia, ASIC, came out with a report in early November basically showing that property developers account for about half the private credit market in Australia. The market, as you said, is quite small. It's about 200 billion Australian dollars. That's roughly 130 billion US. But with half the market tied to real estate development projects and developers themselves, a lot of CIOs at large funds, large pensions, two of the largest we spoke to, are saying because of that relationship to property, which has its own idiosyncratic risks, the market is getting riskier. And at the same time, you're seeing a broadening out of the types of investors jumping into private credit, and that's skewing heavily retail. So I think what's happened is, because this has been such a hot asset class over the past 5 or 10 years, a lot of institutional money has come in. It's quite sophisticated. They're now avoiding some of these real estate developers, and instead retail investors are filling in that gap. They're lured in by quite attractive yields, but with those higher yields is quite risky investments in some cases.
It also makes you wonder, with a hawkish tilt from the RBA, what might beckon in 2026 in terms of risk for private credit. But we're also hearing another warning, this one from Double Line, the fixed income fund manager. They're warning of this brewing collision in developed economies. What should we be paying attention to?
This is a really key issue for fixed income globally. And what this Double Line portfolio manager is pointing to, suggesting that developed economies, think France, think the UK, potentially even the US, what we saw in the middle of the year when yields on treasuries spiked up. It was kind of exacerbated by the government shutdown, but it was these fiscal concerns. And what this Double Line portfolio manager is arguing or making the case for, that some of the dynamics we typically see in emerging markets, the relationship between fiscal spending and social expectations, that's actually going to make treasuries and developed market government bonds a little bit riskier than they might otherwise have been in the past. And I think it's really important to think about this in the context of the higher for longer rate dynamic that we've seen after COVID. That means borrowing costs for developed economies are higher. That puts more fiscal strain on these governments, and that means the social expectations and spending that goes with those expectations from the populace, from voters, is going to be impacted. And that leads then to some political issues, some discord, some sort of disequilibrium politically that can cause more problems. And I think a good analogy would be to think about the austerity period after the financial crisis in places like the UK, which in part led to Brexit. It's these kind of issues that this portfolio manager is speaking towards. I think it's crucial for fixed income investors to be across.
Really interesting. We're seeing these cracks. We'll see whether they deepen in 2026. Richard, thank you so much. Really appreciate your time with us. Bloomberg's cross-asset reporter, Richard Henderson. Now let's look cross-assets in Japan as well. Dollar-yen is moving towards the 156 handle. We have that caution earlier on the Nikkei Chicago futures, turning around a little for the moment. JGB futures also not giving us that much direction. In terms of stocks, yen depreciation, perhaps, rather than higher interest rates, seems to have become the main concern for some equity investors. Let's bring in our Asia equities reporter, Hideyuki Sano. Hide, we're talking about the softer yen and how this has been considered for stocks, mostly a positive. Are we seeing that logic flip?
Hi, Avril. Yes, when you talk to investors and traders, you get the sense that the yen's weakness is becoming more of a concern these days. And it's interesting because, in theory, a weaker yen is supposed to be good for exporters because it makes Japan's exporters more competitive and therefore they can export more to foreign countries. But when you look at what happened to Japan's exports over the last 4 years, the yen has weakened about 25% since then. But what happened to exports? They haven't grown. And in fact, in dollar terms, Japan's exports are still below the 2021 levels. So apparently there's been no boost from a cheaper yen. But on the other hand, it's quite evident that the higher import cost is damaging consumer sentiment, and that's been why voters have been complaining about inflation. So now many investors are starting to worry that a further weakness in the yen might actually hurt Japanese stocks as well.
So if we do see the yen weakening further, which is definitely possible given the gap essentially in rates between the US and Japan, what does Japan need to do in this case?
Yes, I mean, after the BOJ's policy meeting last week, the yen weakened sharply, so that made many people worry that the BOJ has to move much faster in raising rates. I think that's something many investors may think about in the future if the yen starts to weaken further from here. Of course, this partly also is stemming from worries about Japan's fiscal conditions. Again, there's worries that Prime Minister Takaichi's fiscal policy is still not clear to some investors. She's talking about responsible, proactive fiscal policy. Investors still trying to figure out exactly what that means. And probably the market will demand more explanation about what kind of stance Japan will be taking in terms of fiscal and monetary policy, because at the moment the government is trying to boost demand when inflation is already quite high. So that could, at the moment, even though many economists expect inflation to come down next year, but if the government is trying to lift the economy too much, then there's risk that inflation may overheat again.
Hideyuki, thanks so much for joining us this morning. That was our Bloomberg senior stocks reporter, Hideyuki Sana, there in Tokyo. And just in the last few minutes as well, we've seen a fresh record actually for gold, because we're taking a look at gold prices here. The spot gold price above 4,500 an ounce. We have never, ever seen it at these levels. But the rally in metals across the board is very much being fed by tariff fears, especially when you look at copper, but also expectations around Fed easing continuing to play into it, plus the geopolitical situation that's particularly impacting gold prices, given frictions in Venezuela, where the US has blockaded oil tankers, other events, of course, around the world. But we'll leave you with that picture there. As we said, spot gold hitting 4,500 an ounce for the first time. More ahead. This is Bloomberg. China's pushing back against new US rules that will block foreign-made drones and critical components for unmanned aircraft systems. The move from the Federal Communications Commission applies to future imports and sales, but one company is seeing opportunity in this shift, and that's, of course, Brinc Drones. Joining us now is the founder and CEO, Blake Resnick. So, Blake, yes, you're one of the key US drone manufacturers in the States, using a lot of your drones for surveillance, reconnaissance purposes. So, really, when I heard about this Trump decision, I thought immediately of you, just given the impact to a lot of different emergency services, first responders on this. But just explain how you're interpreting that ruling as well.
Yeah, certainly. I mean, China owns the entire global drone industry. And it's actually even more specific than that. DJI is effectively the monopoly player in this space. So them not being able to bring future drones into the country is an enormous tailwind for us and, frankly, for every US drone and component manufacturer.
And so what sort of demand are you expecting to see out of this? Because obviously it doesn't apply to they're not going to be backdating it. Any business unit or service that's already acquired these drones can continue to operate them. But what do you think in terms of your business outlook for next year? What extra demand are you expecting to see?
We're expecting to see significantly more demand. You are, of course, completely correct. This is not a decision that's going to apply to the current in-market, Mavic drones or Matrice drones, but the drone industry moves very quickly and systems become obsolete after not too much time. So over the course of the next couple of years, DJI's current in-market systems will go out of production and they'll become obsolete and they'll be replaced by airframes that are manufactured by us and other companies that are based in the US.
Okay, Blake, I'm going to ask you, because obviously on Bloomberg we like specifics. Can you actually quantify this for us, either in percentage terms or the actual dollar figure, how much more you're actually expecting to make out of this?
I mean, I would say next year it'll mean 8 figures easily for us.
Up from what it is currently, which is roughly what? Can you tell us also the proportion of the market that you guys are cornering right now? And in terms of a 3-year horizon, how much more is that going to look like?
Yeah, certainly. I mean, at this point, our business is really focused on building citywide 911 response drone networks for our customers. So we put drones in recharging stations on top of police and fire station roofs, and then connect all of that technology in with computer-aided dispatch. So the second someone calls 911, we grab, the GPS coordinate associated with that emergency, launch a drone, flies at 60 miles an hour right there. And then when it arrives, it can deliver personal flotation devices, defibrillators, Narcan, other emergency medical payloads, tell police officers what a person is holding before they arrive on scene, spot hotspots in structure fires for the benefit of fire departments, and execute on a whole bunch of other similar missions. And historically, the first cities to adopt this kind of thing have utilized Chinese systems. And having to ongoingly compete with a state-sponsored organization like DJI, as an organization that, like ourselves, that is operating under normal free market conditions, it's just been really challenging. So I think that this is an action that is going to result in ourselves, Skydio, other drone manufacturers in America being, ultimately more competitive in that market, and getting the opportunity to partner with more public safety agencies, while also building up a supply chain and a manufacturing muscle that over time will be very important for national security.
On that note, when it comes to competition, maybe now it's not about DJI, it's also between US manufacturers. What is that going to mean for perhaps the need for fundraising? Are you quite comfortable with where things are at the moment?
I would say we welcome competition with non-state-backed entities. That is what has given me heartburn historically. When you're up against the entire Chinese government financially, you're just not going to win unless that's an advantage that's neutralized by a similar level of state support on our side, which the federal government just hasn't executed on. So, where that leads me is, we're going to have to compete with other US drone companies, and that is totally fine and healthy, and as things should be. In terms of our fundraising ambitions, we certainly have them. I mean, this new government action is going to be a structural tailwind for our business. And I think it makes a lot of sense for us to bring more capital on to go after, our current core business of serving public safety as well as we humanly can. But looking to the future, maybe also start to serve other drone industry verticals that need a secure supply chain.
Yeah, let's just, in terms of that fundraising, though, when would you start to initiate that fundraising round, and how much would you be looking to raise? And are you as well, have you got any sort of IPO plans in the pipeline?
Yeah, I mean, candidly, I would say folks have already started reaching out. I mean, people track this kind of news. Our cash position is really strong. It hasn't been that long since we fundraised before, so we'll have to see how conversations progress. Our last round was a $75 million raise. Prior to that, we brought on 55 million. The round prior to that was 25, and the round prior to that was 2. So I would expect us to raise materially more than 75 this time around if we do end up executing on a process at this point.
Blake, you talked about some of these verticals when it comes to the drone market. How much of an opportunity do you see in the defense sector, and what might that look like for your business?
Sure. Yeah, I mean, listen, the war in Ukraine has proven to the world that drones are the future of conflict. That is obvious. There are, a number of U.S. manufacturers that are highly focused on serving defense customers. I would say that historically we haven't been one of them. Our mission is really today building the best possible technology for first responders and, helping those folks save lives in the context of emergency situations. And, working on defense technology can sometimes come into conflict with that goal. But I do care about democracy continuing to exist. So we'll continue thinking about these issues and make plans to do more work in that space as it makes sense.
I just want to pick up again on that point around the competition with other US companies. You were saying, or we were just discussing in the ad break, around your supply chain. You're not working with any Chinese suppliers directly, so that could be an advantage to you. But what do you know about others in the US companies? Are they also free of Chinese suppliers? Okay, maybe not the full transparency across the supply chain, but where do you stand on that front, do you think?
I would say there's a lot of diversity on that issue. Brinc has been sanctioned by China. I'm also personally sanctioned, so I can't enter that country anymore, which was not an outcome I expected from starting this organization. And most other prominent drone manufacturers, including Skydio, are in a similar situation. I would say many U.S. drone companies transitioned away from a Chinese supply chain prior to the sanctioning activity in order to achieve what's called NDAA compliance, which allows our systems to be sold to federal end users and certain state and local end users. But post-sanction, it became even more necessary for ourselves and other companies in a similar situation to, move away from a Chinese supply chain. And it's been really hard. All of the companies that you would generally want to work with to build a drone system, are based in China. So when you can't work with any of those organizations, what it really means is you have to vertically integrate a lot more than you might expect, because there either aren't organizations in the free world building the parts that you need, or they're so small and immature, it's just challenging to work with them if you're manufacturing drones at a moderate scale. So it's been a big project for us. It's been a big project for other companies in our space. Some have succeeded at executing on that. Others haven't or are in process. And I do think that this will be one of the highest gates that have to be climbed in order for companies to really be successful domestically at engaging in a business like ours.
Blake, great to have you with us this morning. Blake Resnick there, founder and CEO of Brinc Drones, and I look forward to staying in touch, of course, on how your business progresses next year. But let's just move from drones to anti-drone technology, and Drone Shield is one of the companies that's surging so far in the session, up nearly 5% in Sydney this morning, but it has notified that it's received a 6.2 million Aussie dollar contract from APAC military and customer, delivery and cash payment as well expected in 2026. This has actually been one of the best performing stocks on the ASX 200 in 2025. More ahead. This is Bloomberg.
The latest from the corporate front, Bloomberg has learned that Ken Griffin's Citadel is returning about $5 billion of profits this year to clients, and that would bring its assets under management to around $67 billion. Sources say Citadel's flagship fund gained just over 9% through December 18th, putting the firm on track for its worst year since 2018. Shares in enterprise software firm ServiceNow closed lower after announcing it'll buy cybersecurity startup Armis for $7.75 billion. That would be its largest acquisition to date. ServiceNow is looking to use Armis's technology to help clients fend off cyber attacks.
Saw this opportunity and seeing the way that AI adoption is going, this is a great opportunity for us to continue expanding in our security space. So today our security business has crossed $1 billion at ServiceNow. And addition of Armis will allow us to now get into more new capabilities which customers are demanding from us, as well as allow us to really be differentiated as we add AI, data, workflow, with all of it being around security and making sure there are no breaches customers have to deal with.
We just got the BOJ minute meetings being released from the October policy meeting. We did get some initial lines that are saying that they agreed in this period to keep raising rates if the outlook was met. I mean, this was a meeting where the BOJ kept its policy rate at 0.5%, but it did signal at that point that a near-term rate hike was likely. So they were looking at sustainable wage increases, stable inflation as well, despite some of the members wanting more data on US tariffs and global risks. So again, those BOJ meeting minutes just coming out for the October policy meeting. We'll continue to bring you more details on those as they come to hand. But to suffice to say, in the market action today, it's looking like it's going to be fairly quiet, given a lot of traders already away for the Christmas holidays. More ahead. This is Bloomberg.
This is the Asia Trade. We're counting down to Asia's major market opens. And of course, the faring on Wall Street overnight, something to digest as well. Although some might say, don't read too much into it. A lot of traders have already clocked off for the end of the year, this holiday season. That being said, it was all-time highs on the S&P 500. It was led by tech. And you also had some data to support it. The U.S. economy growing at its fastest pace in 2 years. And that is despite some wobbles you're seeing in consumer confidence. Investors seem to think there isn't much to derail the rally. Worth noting as well, when it comes to metals, we have been seeing them extending their bull runs. Yet another record on gold prices, $4,500 an ounce. Levels we haven't seen it at before. Let's take a look at how Japan is faring in the early goings. The Nikkei not really giving us that much direction. You do get the sense that we will be ambling along for much of this year. We did get the minutes from the BOJ October meeting, and the members, based on these minutes releases, told us how they agreed to keep raising rates if the outlook was met. Now, it's worth noting as well that when it comes to the Japanese currency, we have the likes of our colleagues on the stocks team flagging that actually the weaker yen hasn't been that much of a beneficial factor for stocks, given how that hasn't translated into more exports, and that hasn't been a boost since the year 2022. So that's turned the logic on its head a little. We are, again, still seeing stocks moving sideways. The yields on the 10-year still hovering above the 2 handle. Let the board take a look at how South Korea is faring in the early goings, as we have been seeing overall volatility come down. Now, I talked about the data in the U.S. In terms of South Korea, consumer confidence has also been slipping. But if you look at the way stocks are trending, you might not think that's the case. We are looking at dollar Korean won at 14.80 thereabouts. Let's get some insights, perspective in what 2026 is going to look like, and maybe what the rest of the year will hold. Kieran Calder is head of equity research for Asia at UBP and joins me now in the studio. Kieran, great to see you. Thanks so much for coming in. So we are seeing that Wall Street handover, quite positive, but how much are you reading into it?
Well, we think we're set up for a Santa Claus rally, which by the official definition, the clock starts now. So last 5 days of the year plus the first 2 of 2026. The market's taking some of the data pretty positively. We talked about the revised GDP number. Consumer spending out of that was 3.5%. We've seen the early holiday spending from MasterCard, which is 3.9%, led by online, of course. Data pretty supportive into the end of the year.
So if that is the case, does that lessen the need for a Fed to cut? And might that mean fewer policy tailwinds for stocks?
Of course. I think there's a big question mark around what the profile of the Fed looks like with the new governor, new chairman, and that'll be announced any day, or in the first quarter at least. So certainly, if you look at the guidance from the dots from earlier this month, 1 cut next year, but a big spread amongst the different voters. If you look at market expectations, probably nothing going to happen until March or April, and I think it all feeds into the timeline around the new profile of the board.
How should we be positioning between now and then March or April then?
Well, so we think AI investment remains the dominant earnings and theme within the market. So we still want to be positioned there. We'd like to be a little bit, selective if we can. So, for example, you've seen some of the names which had a big pop earlier this year, for example, Oracle, start to come back a little bit. Maybe that's not as great a story as some of the other names. We also think that obviously the power story around AI is a big one because it's going to be the bottleneck unless there's a lot of investment in power globally. And this probably includes the restart of nuclear in Japan and more emphasis on nuclear in other places as well.
I think the last time you were on our program, you talked about the circular deal financing as being a problem for AI. How much of that, narrative carries through into 2026? How much of a problem is that going to be for AI-related stocks?
Yeah, so maybe problem is a strong word, but it's certainly interesting and a risk. So we think, but at the center of it all is OpenAI. So don't forget, this is a private company, has committed to a lot of spending, which may or may not happen. There's a narrative out there that a lot of the numbers you're seeing announced around investment are trying to push others out of the market. All the major hyperscalers, for example, talk about this being a do or die investment. So we think that the major risks are overinvestment. We don't see any return on this. There also is the argument around how long do the GPUs last and how long should they be depreciated over, 3, 5, whatever years. As you mentioned, the circular structure with OpenAI at the middle, we think is a bit of a risk. Is OpenAI now too big to fail, even though it's quite a small company at the moment? And then we think the introduction of debt into some of this financing brings more players into the circle of risk. So we think those are the risks, but we're still positive on the AI CapEx cycle in general.
OpenAI being a private company, but to some, it might not stay that way for much longer, right? Maybe we see one in 2027 in terms of an IPO. What are you seeing in terms of the IPOs from some of these AI names and the extent in which that's lifting the mood for stocks in 2026?
I think for us, we think the major focus there is China. So, obviously being forced, not allowed to buy some of the best chips from the likes of NVIDIA has forced China to develop its own industry. And as we've seen with some of the recent listings out of China, it is. So these are pretty advanced semiconductor names coming to market, and there's more to come. So we think there's a real bifurcation between, global AI story and what China is doing domestically for itself.
Where else in Asia, you think?
Well, everyone else in Asia is following the global model. At the moment, I think China's it. If you're talking specifically about IPOs, obviously Singapore is trying to push itself as an IPO market and has had a couple of big listings this year. But we'll see what happens.
Okay, so that's a very tech-centric story. But we've also been seeing a bit of that rotation to value towards the end of the year. That brings to mind financial-related stocks. We were talking about this during the break. Valuations they're pretty pricey. What are you seeing in terms of opportunities there?
Yes, I mean, in general, financials globally, valuations aren't above average, but we're also, underlying conditions are pretty strong as well. We think that one theme within financials that looks good into next year is the continued recovery in M&A, global M&A volumes, which last peaked before rate hikes started, so 2021, bottomed in 2023, grew by 5% last year and are up 10% after the first 3 quarters of this year. You just have to look at the the news flow from Bloomberg to see there's a lot of big deals going on out there. So we think the global M&A recovery story continues. There's really 3 conditions that support that. One is interest rates, which are going down. 2 is markets, which are high, and then the most important one is this CEO confidence to do deals. And there's a few measures of this, survey type measures, and those are all improving. So we think it's a good setup for continued recovery in M&A.
Which specific markets?
So globally, U.S. Primarily. By sector, we've seen a lot of activity in healthcare as well as tech.
Okay. We'll see what 2026 looks like. Good to have you in the studio for one final conversation on the outlook for the year ahead. Kieran, great to chat. Kieran Calder is head of equity research for Asia at UBP. Now, while we were having that conversation about stocks, also keeping tabs on dollar Korea won, because we have just heard from South Korean authorities this is about a verbal intervention, and they are telling us that they've been holding finance authorities, FX authorities in particular, a series of meetings to discuss FX related issues, and they have been warning FX players will soon see the government's strong resolution. You are seeing a bit of that knee-jerk reaction that popped lower on dollar Korea won. We have more ahead on the Asia trade. This is Bloomberg. You're watching the Asia trade. The U.S. is holding off on new Chinese chip tariffs until at least mid-2027, and that's despite accusing Beijing of engaging in unfair trade practices in the semiconductor sector. Let's bring our China correspondent Min Min Lo in Hong Kong for us. So, Min Min, this investigation was well underway, maybe because of the trade truce, the détente between Trump and Xi. We are seeing Beijing kind of off the hook. Tell us more about this.
Yeah, this is a probe that is about 1 year in the making. It was launched in the final few weeks of former U.S. President Joe Biden's administration. It was expected that President Trump would resolve it. And the U.S. Trade Representative Office has found in its probe that China has aggressively and sweepingly used non-market measures to increase foreign dependence on its products in a way that is disadvantageous for U.S. commerce. But their decision is to impose no tariffs for the next 18 months. And when it comes to June 2027, they will increase tariffs, but the rates are only going to be announced at least a month before that. So this is a clear signal that President Trump is perhaps in some ways trying to stabilize ties with China, trying to maintain that trade truce that he agreed upon when he met with President Xi in October in South Korea. But at the same time, also leaving himself that opening, right, 1.5 years down the road, a bargaining chip, if you will, when it comes time to renegotiate the extension of the trade truce 1 year later. So interesting to keep an eye on this. It will apply to not the end products like smartphones containing chips, but to the inputs like the electronic integrated circuits, the diodes, the raw silicon, for example. Those could face tariffs in 1.5 years' time.
Min Min, thank you so much. Bloomberg's China correspondent Min Min Lo for us. Now, some other top global headlines we're following. Nearly half a dozen tankers laden with crude have departed from Venezuela's coast despite increased pressure from the U.S. Data from maritime intelligence firm Kepler show most of the tankers are headed to Washington, and at least half of them are chartered by Chevron. This comes as the Trump administration intensifies efforts to curb Caracas oil revenue by targeting sanctioned vessels. The U.S. Supreme Court has refused to let President Trump deploy National Guard troops in Chicago. A majority of judges ruled that the administration failed to identify a source of authority that would allow the military to execute the laws. The move is a setback to Trump's drive to use the military in cities across the country, including New Orleans, where authorities have just deployed 350 troops. Now on to one of our top stories as well. The U.S. Justice Department has released another tranche of files related to Jeffrey Epstein, including some that add fresh pressure on the U.S. president. For more, let's bring in Bloomberg managing editor Jill Deesis. So, Jill, we are learning a bit more about what was in the Epstein files, but how much more given the way in which they've been released at this stage?
Yes, I think at this stage, Avril, really, a key element of the story here is the fact that so much of these documents is incredibly heavily redacted. We obviously did get this latest tranche that was released. This is after the big release on Friday. I mean, you're looking on your screen right now at literally so many of these pages are just completely blocked out. Now, of course, in some respects, much of the information that's censored may be pertaining to victims, and there are certain legal obligations to protect particularly any underage victims that may be contained within these files. But this has kind of led to a lot of widespread fury, both among Democrats and Republicans over the level of transparency, or rather lack of transparency, that's actually contained with these files. And it does appear to be something that just continues to be an albatross for the Trump administration. I mean, this is a case that Trump himself has really kind of been all over the place on over the last 11 months that he's been in office, and it does seem like it's something that does continue to dog his administration.
So how much of a political challenge is this going to prove to be, especially given elections next year?
So I think at this point, Avril, it's really tough to say. If you're actually looking at, how Republicans and Democrats and independents have responded to Trump's handling of the files, I think it's fairly unsurprisingly split along party lines. 55% of Republicans in one recent poll said that they approved of Trump's handling of the documents. I believe it's, sort of a flip side of the majority of Democrats and independents do not approve. All that being said, I mean, the midterm elections are still roughly about a year away. A lot of voters have said that they'd, rather frame a lot of their expectations and sort of voting expectations on economic concerns rather than that. I mean, that's actually something that we've seen Trump really pivot to in some recent addresses, including his end-of-year address, this idea of trying to defend his record on the economy as, obviously a lot of the messiness over the release of the Epstein files continues to, sort of unfold there. So it may be that it could be that, in a year's time when voters actually go to the polls and you actually see, some of the results of those midterm elections, you're seeing something that's much more focused on, response to sort of economic pressures rather than anything related to this matter. But again, it's really kind of too early to tell.
Jill, much appreciated. Thank you for bringing these nuances on the story to us. Managing editor Jill Deesis. We have more ahead on the Asia trade. This is Bloomberg. A wave of visits to Taiwan by Japanese lawmakers is underway, drawing a sharp response from Beijing. Japan government reporter Sakura Murakami joins us now. Sakura, these visits in themselves are not unusual. It's just the matter of the timing in which they're coming. Put things in context for us.
Yeah, so basically there's one of the senior lawmakers of the Liberal Democratic Party, Koichi Hagiura, has visited Taiwan. That in itself isn't that unusual. It's quite common for Japanese lawmakers to show their support for Taiwan to visit. The thing that is different this time around is that this is happening right after the spat or the dispute with China has developed. And China right now is quite angry at Prime Minister Takaichi for making some comments about Taiwan. So there is this tension as a backdrop that is usually not so strong in the context of these visits.
Talk to us as well about the senior figure within the LDP that embarked on this visit. I mean, is there a way that on a government level they are distancing themselves from this being seen as sort of an individual trip?
Yeah, well, the Hagiura, he is a senior member of the LDP, and he's known to be quite close to the Abe faction. So that's the former Shinzo Abe's faction, and he's also, in that context, quite close to Prime Minister Takaichi as well. But that being said, the Japanese government doesn't have formal ties with Taiwan, and they're saying that these are individual visits done by lawmakers in an individual capacity or a party capacity. This doesn't represent the government in any way, and the government can't, dictate what these individual lawmakers and individual parties should or shouldn't do. So they are sort of saying this isn't really the government doing anything. It's these individual lawmakers making their own choices about what to do.
Sakura, thank you very much for the latest on this. Our Japan government reporter, Sakura Murakami. Now, staying with geopolitical developments, we are certainly seeing those tensions in Europe as well, particularly from the likes of France, and how they're demanding EU action to counter Chinese duties on dairy. We are also keeping tabs on U.S. sanctions on a former EU official. Among the swipes that have been taken at Europe. For the moment, of course, it is a thin holiday trading sort of scenario. Stocks 50 futures not giving us that much direction. Staying on Europe, U.S. listed shares of Novo Nordisk also surged on Tuesday after it won approval to sell a pill version of its blockbuster obesity shot Wegovy in the U.S. CEO Mike Doster spoke to Bloomberg about how the development could shape up and shake up the competitive weight loss market.
This is really going to be super exciting for the millions of patients that have been waiting to get their hands on a GLP-1 pill. And for the first time, we are having a pill that has an efficacy of some 17% if you take the pill regularly. And 1 in 3 people are going to actually reduce up to 20% weight loss. I think that data speaks for itself, and we are super excited, of course, to be the first to the market, and we're going to go all in trying to make this a huge success.
Well, moving forward, I mean, beyond just these first few months, after Eli Lilly does have their pill on the market, how do you plan to compete? What is your strategy there, given my understanding is that there's likely going to be no restrictions when it comes to food, when it comes to drinks around Lilly's version?
Yeah, so as I mentioned, there are no other phase 3 trials of oral GLP-1 that has shown this level of efficacy. This means that for the first time ever, people do not have compromise between either taking an efficacious injection or a convenient pill. For the first time ever, you have the same efficacy of 17% in injection or a pill. You can take it on a daily basis as a pill or a weekly injection. And that, I think, is the key selling points with Wegovy pill. We also have more than 10 years of course, experience with regards to safety data and what have you. That's why it's called the Wegovy pill, which means that this pill is not only going to reduce your weight, it also has protection for your cardiovascular systems. So this is a phenomenal pill, second to none, I would say, and we are very ready to compete with it.
Let's talk about how you're going to sell it. Through what channels will you sell this Wegovy pill, and will all of those channels be available at launch?
The quick answer is yes. We're going all in. We're, of course, going to sell this through our own websites, NovoCare Pharmacy, as well as all of our partners, be it Ro, LifeMD, Costco, Weight Watchers. Everyone that you can imagine is going to start launching this at the same time on the day of the launch. Trump RX, of course, will be coming up soon as well as, of course, the traditional channels that usually medicine is procured in U.S.
Some other corporate stories we're tracking. Shares in enterprise software firm ServiceNow closed lower after announcing it'll buy cybersecurity startup Armis for $7.8 billion, and this would be its largest acquisition to date. ServiceNow is looking to use Armis's technology to help clients fend off cyber attacks.
We saw this opportunity, and seeing the way that AI adoption is going, this is a great opportunity for us to continue expanding in our security space. So today our security business has crossed $1 billion at ServiceNow. And addition of Armis will allow us to now get into more new capabilities which customers are demanding from us, as well as allow us to really be differentiated as we add AI, data, workflow, with all of it being around security and making sure there are no breaches customers have to deal with.
Bloomberg has learned that Ken Griffin's Citadel is returning about $5 billion of profits this year to clients, and that would bring its assets under management to around $67 billion. Sources say Citadel's flagship fund gained just over 9% through December 18th, putting the firm on track for its worst year since 2018. We have more ahead. This is Bloomberg. Let's take a look at how Aussie assets are faring. Of course, this has been a year where the stock benchmark has underperformed the Asia-Pacific peers, and this is despite material stocks doing pretty well, especially where commodities are at the moment. Aussie dollar also really not giving us that much direction as the year winds down and the holidays approach. So perhaps useful to turn our attention as well to consumer spending in Australia, where shoppers are expected to shell out $37 billion this festive season, a 32% jump from last year. And that's according to new research from Finder. Joining us now is its head of editorial, Sarah Megginson. Sarah, good to see you, especially ahead of the holidays, but to some that's already begun. What are you seeing in terms of these consumer spending trends?
Yeah, we're seeing it increase quite dramatically, actually. So spending across the silly season is up about 60% on last year. And it's across a range of categories because over Christmas, there's the Christmas presents, but there's also travel and accommodation if you're traveling to spend time with loved ones. And there's all the food prep that goes with it. And in Australia, there's also a lot that gets spent on alcohol. So when you add all that together, it comes to about $1,750 per person. So it's a huge amount that people are outlaying for the silly season.
Boozy Christmas, I think, is what you're getting at. But aside from that, this holiday period, I mean, are you in any way seeing them perhaps tightening their belts, given how, there's a bit of uncertainty about the economy?
Yeah, it's actually really fascinating because we see consumer spending, the pattern is really different around the Christmas season as it is to the rest of the year. So we're actually seeing the Black Friday sales be our biggest sale period of the year. It's overtaken Boxing Day for the last few years. And Australians spent over $6 billion this Black Friday. And a lot of that was preparation for Christmas. So people were quite smart and strategic and planning ahead and buying their Christmas presents. But we do also see that a lot of people are planning to spend in the Boxing Day sales as well. So the research is showing us that around $3 billion is expected to trade on Boxing Day. And these are just huge sums of money. And it's especially interesting considering we were largely expecting a rate cut in November or December, and that didn't come through. So where people are getting all this money is a little bit of an interesting thing to ponder, but we can see that appetite for spending is high.
Which brings me to my next question about debt levels, and how consumers are, I suppose, bankrolling this.
Yes.
What is that going to mean for, 2026 sort of spending habits?
I know, I always feel like a bit of a Grinch when the conversation turns to this because Christmas is spending and celebrating and joy, and then we talk about the debt and paying it off. And that's a bit too much of real life. That's a January problem. But it is something that we can't keep our head in the sand with. We know that every year January is a huge month for credit card debt. Australians are carrying record high levels of interest-bearing debt, which means that they're not paying the balance in full each month. That's gone up $1 billion over the last last year. So that's a huge amount of debt people are carrying. And if that's something that is familiar to you, January is a perfect time to look at maybe a balance transfer card, which is where you transfer your credit card balance to a new card and you pay 0% interest for a period of time. And that can help you really rein it in and pay it off without paying interest. You could also look at consolidating your debts, but January, of course, is the best time to think about your goals for the rest of the year, especially your financial goals. And if you have overspent during the silly season, this is a good time to look at all of that spending and try to get a plan in place for the new year.
Does that sort of bring to mind as well? I mean, you talk about the easing that was expected from the central bank. Obviously, it's had a more hawkish tilt. Some people are now talking about a hike. But is that something that, weighs in the minds of consumers or borrowers?
I think it's always in the back of their minds. Certainly, our research shows that whether you're renting or you're paying a mortgage, you are struggling with these expenses more than ever before. Housing in Australia has never been this expensive or taken so much of our weekly pay or our monthly pay. The measure of mortgage stress in Australia is 30%, and that is something that most people are at that level now. Meeting people that are paying 50% or more of their income towards their mortgage or their rent is really not uncommon anymore. So I think we do have a lot of people who are struggling financially, but Christmas is that time of year where perhaps sometimes we really figure out how to make it work, whether that means we go into debt, whether we figure out how to do buy now, pay later or borrow money or whatever it is. People really do prioritize spending at Christmas, and that means they can actually overspend and start the new year in a lot of stress. So I think it's ideal if you can have a really realistic look at what your budget is. I mean, for a lot of people, we're at Christmas Eve, so the spending has happened, and now it's about looking at the new year and how you can make sure you don't end up in this same situation next year. Kind of look ahead at what your options might be to consolidate your debts or to look at your spending and see if there's opportunities to save on your everyday bills. We know that all of the bill categories have gone up in the last couple of years. So there could be opportunities to save and then take a little bit of stress off your budget, work at paying off that debt so that you can start the new year in a bit of a fresher financial mindset.
Is there a bit of a shift or a split among the way younger Australians think about this versus the older generation?
Absolutely. We can see actually that generational divide, it evolves year on year. And we see that that's because society has shifted so much and we now have so much access to outsourcing. So younger generations are much happier to pay a premium for something if it means someone else would do it for them. And a great example of this is around Christmas time, picking someone up from the airport. It's something no one wants to do. There's a lot of traffic. It's a lot of chaos and stress. And older generations, that's just something you do at Christmas time. You pick your family up from the airport. Younger generations, we're seeing them say, I'll send an Uber for you, because they would much rather pay a small premium to outsource that problem and be able to stay at home and continue doing what they're doing. We're kind of outsourcing inconvenience and paying a price for it. And older generations are just they're not as used to having access to that. And they're also not as interested in spending money on things that seem frivolous like that. So we do see that really shift spending habits and how people are really embracing the gig economy and the ability to get things done for you. And they're not as interested in the value that you get from it, because to them, the value is their time. Getting their time back is really a high priority. And so we see that play out across the different generations. It's almost textbook in that you see the older generation, so boomers, have very little interest in buy now, pay later. They have very little appetite for those types of convenience services. Then when you go down to Gen X and millennials, that appetite grows. By the time you're at Gen Z, they are the biggest consumers of those convenience type apps and services. So it really does change the way people spend and the consumer appetite for different products and services. And I think that will just continue to grow and evolve, because those conveniences are just getting bigger and bigger. We're seeing more and more opportunities for people to outsource things. You can even outsource things at Christmas time, like you can have someone come and put together your trampoline for you, something that I think my parents' generation would never even dreamed of. You can now pay someone $70 to come over and build your Christmas toys for you. So it's a really different spending paradigm now than what it was.
Yeah. It's an interesting generational gap we're seeing, and it will also be interesting to see how businesses adjust to these changes. Sarah, great to chat. Thank you so much for your time today, and happy holidays. Sarah Megginson is head of editorial at Finder. We have more ahead on the Asia trade. This is Bloomberg. Now, we've been talking on the Asia trade about how it's a quiet holiday period, but South Korean currency officials are giving us something to chew on after strong currency warnings, verbal intervention, and giving us the signals that, they are strong and determined in terms of pushing back the moves we've seen in Korean won weakness. That's actually brought dollar Korean won down more than 1%. So we are seeing that appreciation in the local currency. And of course, we are watching for the open of markets in China in terms of appreciation. The Chinese yuan has also been appreciating for much of this year. Let's turn our attention to an EV maker out of there as well, EV battery maker, CATL. And of course, this is the world's biggest. It's powered 1 in 3 cars sold this year, and that's according to data from South Korea-based S&E Research. But as growth slows in China, CATL is now looking abroad to boost its business, and Bloomberg's Asia transport reporter Linda Liu joins us now. Linda, so what is at stake for CATL? Put things in perspective for us.
Like you said, CATL is already world's biggest battery maker. The big challenge for them now is to maintain that momentum, because it's facing challenges such as a slowing demand in China, where not just EV sales, but car sales are looking shaky given the weakening economy. And then you look overseas to Europe and the US, where support for EV incentives are being scaled back. So all of that adds to a lot of uncertainties about the demand for EVs. And then you throw in geopolitical tensions, with the EU levying tariffs on Chinese EVs, as well as the US essentially shutting a lot of these Chinese-made products like batteries as well as cars out from the US domestic market. So CATL is really exploring new business models such as localizing production in Europe, as well as working with US automakers through a licensing, royalties and service model that it hopes can help it gain some sort of access to the US market.
Linda, as you allude to these geopolitical tensions, these new business models that CATL is looking at, might that also have a bit of a risk involved given the backdrop?
Yeah, there's definitely risks involved. And what CATL is hoping to do is, for example, in Europe, it's built factories in Germany and Hungary, and is also looking to build another one together with Stellantis in Spain. So it's hoping that these models, by shifting production to be in Europe, that it can evade the geopolitical scrutiny that Europe has levied at products that are made in China. But localizing production comes with its own sets of challenges. CATL, as you can see in our Big Take reporting today, has said that the efficiencies as well as costs at its European factories is, cost is higher, efficiency is maybe not as that of the factories in China. So customers, asking them to mix up their battery orders still with batteries made in China together with that made in Europe. Looking at the US, its major partner Ford is walking back some of its EV commitments. So that's led to some rethinking of the licensing deal with CATL. Ford is now actually planning to leverage this partnership with CATL to really pivot into the energy storage systems market, one that's actually seeing a lot of demand from the growth of AI data centers. So that will be a really interesting pivot that we're keeping watch.
And when can we expect CATL to reap the benefits, the payoff of this pivot?
Something that we're going to really keep a close eye on. It really depends on how successful Ford and CATL can leverage the LFP technology that CATL is providing to Ford. Another factor that you have to consider is that Ford isn't the only player kind of in this market. Tesla is probably the EV maker that has a lot of head start in making energy storage systems and selling them that already. It's one of the major revenue streams for Tesla. So Ford really has to compete with existing players, really market to its customers that its technology, thanks to CATL, is one that can provide a lot of benefits as well as probably at a greater cost savings to consumers.
What about the markets that it's likely to prioritize? I mean, you spoke about some of this a short while ago, but given the backdrop, what is that going to look like in the next couple of years?
So we've talked a lot about Europe and US, these two major global markets, but for CATL, its home market, China, remains probably one of its biggest. Given how much EV sales are happening there right now, the world's biggest. So CATL is focusing on launching newer technologies in China. It's really pushing this model. It's called the skateboard chassis platform, essentially, hoping to help EV makers bring to market newer models faster. Essentially, CATL is, telling automakers, we'll take care of, the battery side of the EV, one of the major components when you're going through design and development of an EV. And the automakers essentially just need to take care of the other parts, such as functionalities, as well as the design and appearance of the car. So these new kind of platforms that CATL is marketing, it's hoping to gain newer revenue streams and probably command a bigger part of the cost that goes into these vehicles. And so hopefully CATL can attract customers with some of these newer offerings.
Linda, it's been really great to chat, and I recommend our viewers to take a look at today's Big Take as well. It's really fascinating how the EV battery maker is looking at these new business models. Bloomberg's Linda Liu for us. And some other corporate stories we're tracking. China's COMAC is set to miss its annual delivery target for its C919 single-aisle jet by almost 50%. Data from Cirium and planespotters.net suggests COMAC shipped just 13 of its flagship planes this year, well short of its target of 25. Plane makers expected to have received the C919 this year include Air China and China Eastern. And we're going to be watching CNOOC shares when they open in the next hour. That's after it announced a major oil field discovery in the Bohai Sea. CNOOC says the Tinhuangdao 296 holds 100 million tons of oil, with a discovery well producing 2,500 barrels of crude a day. And taking a look at China futures as well in the Greater China markets, we are, of course, on a period where things have quietened down a fair bit. It was interesting how we saw tech stocks bouncing in the US, so looking at whether that translates into a bit of a boost for not just tech in the region, but more specifically in the Greater China markets. We are also watching some other investment trends in China, including how infrastructure bonds have been drying up. More ahead on the Asia trade. This is Bloomberg. We saw that bounce on Wall Street overnight, the S&P 500 all-time highs, tech-led rally. We had the data sort of supporting the case for this in terms of a Goldilocks scenario where GDP growth it was fastest pace in 2 years, although consumer confidence didn't look that great. It's decline they've been seeing for a number of months now, but investors overall didn't see enough that could derail this rally. Although you're seeing futures very, very, very slight pullback for the moment, it was also interesting to see the more policy-sensitive part of the Treasury curve, the 2-year yields. We're still around the 3.5 handle. 10-year bond futures picking up just a slight bit. Meantime, the U.S. president is crediting his tariff policy for the better-than-expected U.S. GDP growth in the third quarter. In a Truth Social post, he said the U.S. economy, in his words, will only get better. When Donald Trump rolled out global tariffs in April, economists braced for the worst. Since then, a lot has happened, but the sky hasn't fallen yet. So were the experts wrong, or is it just too soon to tell? Our team at Bloomberg Intelligence takes a closer look.
Credit where credit's due, President Trump made a big bet that the US had a magnetic appeal, and that would enable him to get a better deal from US trade partners and companies that want to do business in the United States. On the evidence of the last few months, that bet is playing out pretty nicely. Economists don't agree on much. One thing they do agree on is that free trade is good and that tariffs are bad. For a moment, Trump escalated US tariffs on China all the way to 125%. If you plugged the US tariffs into a model of the global economy, what it said was that there was going to be a really significant drag on growth, and there was also going to be a significant upward impulse to prices. But when we look at what's happened to inflation over the summer, it's not come down, but it's not come up either. Why is that? It's because US importers and foreign exporters saw the Trump tariffs coming, and they rushed to front load shipping to the United States before the tariffs could come into force. One thing that's happened is that we've gone from a lot of unexpected bad news concentrated on a single day to a series of country-by-country deals. There's something of a Swiss cheese of exemptions and carve-outs. The trade war is a drag, but it's not the only thing which is happening. We've got tax cuts with Trump's One Big Beautiful Bill, and we've got a bonfire of regulations which is stoking the animal spirits of US businesses. We've also got the artificial intelligence boom and a huge amount of investment going into data centers. Tariffs are having an effect. China's exports to the United States are way down relative to the historical trend. So, who pays for the cost of tariffs? Despite his well-known love of gold, the president is not an alchemist. He can't make something from nothing. That money has to come from somewhere. All of the evidence so far suggests that in the end, the bulk of it is going to come from US businesses and US households.
And if you want to watch the full version of that report from Bloomberg Originals, you can go to their YouTube channel. It's also available on the terminal and Bloomberg.com. Now let's take a look at how precious metals and the industrial metal copper are faring as well, because these are the ones that have been hitting record after record. $45.15 an ounce is where gold is. I mean, we've been seeing it propelled the past couple of weeks by the tensions with Venezuela and the U.S., but what is happening in platinum is also providing a coattail of sorts for the yellow metal to ride on. We'll continue tracking these moves in metals. That's it from the Asia Trade for 2025. Our markets coverage continues. This is Bloomberg.